Hit it.
It's Friday, March 22nd, 2024, episode 235. I'm Patrick Ceresna.
And I'm Kev YWR. This week, we have a wonderful discussion with Erik from Your Weekend Reading, where we talk about his time investing in Africa and how that has helped him navigate the recent uptick in inflation, why investors are underestimating the risk of getting left behind, and Erik shares with us a surprising stock pick from his side of the pond. Then Patrick pulls out his pack of Crayolas to forecast what's ahead in talking charts.
And we end with crayons with Kev, and folks might even drink some beers along the way. So Danny, hop on. Now, I went out of my way to make sure that we both had a beer so I could say, what beer are we drinking today? But what happened, Danny?
I got desperate in the week.
Now, so very on brand. So he needed a beer, so he drank it.
Yeah, but he did say, I did take notes.
Yeah.
So you'll rate it.
So this,
right. So what beer am I drinking?
Okay, so you're drinking a Marks and Spencer's American Pale Ale, which, if anybody isn't British, Marks and Spencer's is basically a commuting shop where you live in London, and on the way to, I don't know, you're going to go home, you're going to jump on the tube or the train, you go to Marks and Spencer's and you pick up one of these little cheap American Pale Ales. But I have to say, I was quite impressed. I know you're supposed to read it later, but you know.
Yeah, you got to save it.
Yeah, we'll rate at the end. Actually, it was pretty good on first sip here.
Yeah.
All right. Kev,
Hoppy
give us some
bold.
Disclaimers.
All right. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include echonobluritis, I can't even say it, forecastic whiplash, and trendylolysis paralysis.
Ooh, I suffer from
those.
That
Were
one.
really hard ones you made up today, Patrick. I couldn't say half of them.
All right, let's get to the guest.
It's our great pleasure to welcome to the show Erik from YWR, which stands for Your Weekend Reading. Erik, thanks for making time for us.
Thank you, Kevin. It's great to be here.
I must say I have been looking forward to this because I've been reading your stuff for a while now. You come highly regarded in terms of our buddy Cuppy said, you got to get Erik on the show, and you're finally here. So it's going to be a lot of good things. So before we get into your calls, let's just chat a little bit about your life, your background. And although you're not Canadian, you spent the first few years of your life in Canada.
Yeah, I lived in Calgary in the 80s with the Calgary Flames playing the Edmonton Oilers and Wayne Gretzky. And so, yeah, I started playing ice
hockey. So you were in
there.
Calgary, so you were actually a Calgary Flame fan, and you hated the Oilers.
We hated the Oilers, and it was such a big rivalry. And it's funny to talk to Canadians that know that time. They're like, oh, yeah, those were great games. And, so long ago, but they were fun.
Oh, they were. And the other thing that people forget is that the score was often like 10-9.
Yeah.
It was a different game for sure back then.
Yeah.
All right. So you're there. Are your folks like doing oil stuff? Is that why you're there? And eventually you moved to Montana.
Yeah. My dad was doing real estate there.
Okay.
Yeah. And it was at the time Calgary was going through a big, a down cycle in oil. So it was kind of a tough time, one of the tough times before the oil sands ramped up, but yeah.
And so you guys then moved to Montana.
Yeah.
Where did you move there, and what was it like spending the next part of your life there?
Yeah, I went to high school in a town called Great Falls. So I was relatively coming from a big city, which was Calgary, but it was just straight down 6 hours south of the border. And it was a very small town, 50,000 people, ranching town. And I went to a small high school there in Great Falls, Montana. Really good experience. Loved it, had so much fun. And, but then, wanting to I'd always had the bug for markets. And so I was like, I can't stay here forever. So I went to school out in the East Coast. And then after graduating from college, went and worked in San Francisco. Funny thing was I tried to work in New York, but didn't end up getting a job there. So I had to come up with a plan B. And I was like, well, God, it'd be nice to live in California. And so I just packed up my car. So I worked a summer in Great Fall, went back to Montana, did landscaping for a summer to save up some money, packed up my car and headed out to San Francisco, and just got a job out of the paper with a mutual fund company.
Okay.
Which
is this between your undergraduate and your graduate work?
Yeah. So this is after graduating from college.
Right.
21, 22, and working for a mutual fund company, which is now Wells Fargo Asset Management, but it was called Montgomery back then. And I got my first job. I worked my way up from customer service, but then became a global banks analyst for this about $10 billion mutual fund company. And I covered, and this was basically the first 12 years of my career. I covered global financial services. So banks in Europe, especially banks in Europe and a little bit in Hong Kong and Australia, banks, insurance companies. And so that's why I often take a strong view on financial services in my newsletter, because it goes back to that period of time.
And is this in the late 1990s, early 2000s? What would give us kind of a feel for when this is?
I graduated 97 from college. Okay. So yeah, right out of the gate, like within months, we had the Asia financial crisis. So we had that was one of my early things, Thai banks getting smashed. And then there was the .com bubble, being in San Francisco during that, being at a, multi-sector global fund. And I remember those discussions, all the different sector heads during that time. Then we had the financial crisis, the tech crash of 01, 02, the ramp up, and then
actually, before we go on to that, you mentioned that you remember those discussions. What sticks in your mind? Like, I'd love to hear
there was there were two things that, and I don't know if they're relevant, but I do. Well, one thing was I was the junior guy on the team covering banks, and I'd kind of gotten this great opportunity because our senior banks lady had gone back to London. So I kind of got elevated to senior banks analyst. And so we were sitting around the table trying to decide how much we should put in tech. And tech was screaming, and our tech analyst was pounding the table, how fantastic it was. And the conversation comes around to me and go, Erik, banks was always a big sector. It was always like 20% of the portfolio. And they're like, Erik, what do you think? What should we take some money out of the bank sector and put more into tech? And I was like, well, they are cheap, but it doesn't sound as exciting as your stuff, so, we carved out another few percent out of the banks, put it more into semiconductors and this and that. And this was in 99. And of course, in hindsight, it was the wrong move. We pretty much were adding to stuff within 6 months at the top.
You were doing the famous Stanley Druckenmiller.
Yeah. I mean, I was more just on your stuff sounds great, Bob. I mean, I've got a mortgage bank in the UK. It sounds like I didn't have any experience, right? I was just
right.
So I was caught up in the whole thing too. Right. And, the other conversation it's funny that you're getting right into this stuff, Kevin. The other conversation that I remember, we were because the Fed was raising interest rates at the time, but the market was steamrolling through it. And I remember having the conversation. Someone at the table was saying like, "Oh, we got to be careful. The Fed's raising rates. This could have some kind of lagged effect on the market." And our tech guy was saying, "No, it's not having the money supply that's coming from the IPOs, the amount of money coming in, there's no actual tightening of financial conditions going on because of all these IPOs. So actually, it's going to overpower the Fed, and we don't need to be worried about these Fed interest rate increases." And that, in hindsight, ended up to be wrong as well. But I just remembered that argument. And right? Because
that's fascinating because it's so much like today, right?
And I'm struggling with that same thing as well right now. But those words are, yeah.
All right, so you're there. So you keep going. So you're let's keep going through your career.
I had this view that the firm ended up downsizing. Because basically that mistake of overweighting tech imploded our performance over the next 2 years, right? So we had downsizing. I had to leave and join some other small firm, and I had this in my head that was like, okay, well, if I cover Europe global financials, and I really want to be good at this, I should probably go to the place where, I shouldn't be in San Francisco. I should be in London. So I was like, I think I need to make this career move to actually transition myself to London. So that's where I left the firm I was at and went to a hedge fund in London in 2002. So
All right. Okay.
yeah, so then I spent
So what was that like in terms of like a culture shock?
Tough. And because I loved being from Montana, I loved living when you live in the Midwest, or I don't know, most places in the US, living in California is a dream, especially if you're from Montana. So I loved California. I loved the sun, the sports, and the outdoors. So it was a very difficult thing to go to London and
not see the sun for the next 4 years.
And no real outdoor. In San Francisco on the weekends, you're going skiing and mountain biking and doing all these things. There was none of that, right? But during the week with the finance, it was really exciting. But during the weekends, it was terrible. And I've actually moved back to California, I think 3 times. In this current time, I've stuck. But in my life, I have had this push-pull of, London is good for work, but I hate the lack of sun, and I go back home, get homesick. But now this time I've been here for 7 years. So
I'm not falling for it again.
Mm-hmm. My wife has told me to just accept my lot in life, that I need to be here. So just stop it with the back and forth.
All right. Okay. So you go to London, you work now, are you still in equities and you're still doing somewhat the same thing, or are you moving on more to portfolio manager?
Yeah. Kind of like senior analyst, running a small book within a bigger firm with a portfolio, like giving, where they kind of give you like, here, you can run 50 million and the main guy runs like 2 billion or so, or some bigger, but we'll let you have a little pot where you can play around with. So I did that. Another firm I worked for ended up shutting down, and I had this opportunity to go back to California and work for a hedge fund called Passport Capital in San Francisco with John Burbank, which ended up being an amazing experience. And so actually that was one of my times I go back to San Francisco in 2006.
Right, like that's a famous shop. Like that's Passport Capital.
Oh,
like,
it was legendary. And just working with John Burbank and how it's not, I try to take on some of his skills. He's at another level. So, and how he can manage things that other people can't.
So what was the biggest surprise when you had been in the markets for, a decade at this point? You go back to San Francisco, you go and you get to be under this John Burbank. What was the biggest surprise about what he did different? Like, what was the things that kind of like, you're like, wow, this is in a different league?
Oh, it was nonstop. I had an opportunity to work I got 2 job offers back in San Francisco. One was at a mutual fund, which was Dresdner Bank. And I was like, do I do the safe mutual fund? And I'd already had a fund in London close on me, right? So I was like, I don't know if I should go for the small hedge fund thing again. Maybe I should go back to the aircraft carrier mutual fund thing. But it seemed so boring, right? And John seemed so excited. I was like, I don't know. I get sucked into it again. So I went to the small hedge fund, and he had been compounding at 25% a year. So he had grown to 500 million under management. I'm like, okay, well, it seems like he's doing okay. So I joined, and then 2 months later, he'd just taken in $100 million from Goldman Sachs fund of funds. And so things were all great. And 2 months after I joined, he goes from up 25% on the year to down 9. Down 8 or 9. Yes. And before I joined, he had put 25% of the fund into a unfollowed Indian stock called Reliance Capital, which was one of the Mumbani brothers. They split their dad's business up, and this was one of the collection.
Which has gone on to be one of the India's biggest companies.
Is Reliance Capital done that, or was it Reliance Industry? I don't remember.
Maybe I've got it wrong. Maybe I've got I just heard Reliance, and I just knew
it was. I think it was the other one.
So he's got this big huge position, and then it gets halved or something.
Oh yes, and we get murdered, right? So, and then Goldman Sachs freaks out that they've just put money in this hedge fund, and it's had a equivalent 30% drawdown top to bottom, right? They didn't think that was possible. It blew out all their analysis of what this fund was going to do and the risk profile of the thing. So they end up redeeming immediately. Like they've only been in the fund like 9 months or something. And so our AUM have gone now sub 400 or something. And John refuses to sell anything. He's like, no, I am not selling a single share of any of these things. They are the greatest ideas ever. We were in this, like 25% of the fund in this Indian asset manager, rig stocks. We had a rig fund, a special fund that all it did was own 8 publicly traded rig stocks. Right? That sounds weird, but actually it was a thing. Right?
Rig is in like the drilling rigs?
Yeah, Transocean, all those things, right? Yeah. And then we had an India fund. We had a mining fund, right? So we were in mining, emerging markets, India, oil, all those great themes, right? He had them, every one of them. Oh, and we were doing shorting subprime. We had a subprime fund, subprime CDS fund as well.
Wow.
Which was another thing that was amazing about him. So then basically what happened, which I thought was amazing, was he never sold a share. He went back to the prime brokers, levered up, just said, look, I need more leverage. I'm going to keep all these positions. And then he said, guys, because like we'd gotten beat up and we were embarrassed, and it looked like a normal fund would have been kind of shirking or embarrassed about it.
Yeah.
But he goes, no, we need to suit up, as in put suits on, because we didn't wear suits in San Francisco. We wore, fleeced vests. We worked above an art gallery. And he's like, no, we need to put our suits on, go to MidTown and market the fund and raise more money, because this is the best time ever to come into what we're doing. I think we're about to make a ton of money. And I was like, oh my God, that is like the most ballsy, awesome thing to like get on the front foot and go, no, I'm actually not embarrassed about this. This is actually for you, this is the best opportunity ever. The next year, that was 2006 that happened. The next year, the fund was up 270%. Because every single thing worked. EM went up, gold went up, India went up, and mining was firing. And the subprime trade worked too, which is a weird thing, that the US was cratering and the spreads were widening, even though EM was going up and not noticing, which was kind of a weird, yeah. But anyways, it was insane, right?
That's an awesome story.
So John, I was like, that guy is next level, right?
Right.
So anyways, so Passport was great.
And so how long did you stay there? And when did you get, you have a master's in economics and finance. When did you do this?
So that was 2 years ago. So various things happen. I run an Africa fund for a while, which ends up having to close in 2021. Just couldn't raise money, understandably, because it was terrible versus the S&P. I'm trying to sell it to Europeans and everybody. But I had a reset. Like I was like, oh God, I think I need to do a bunch of things differently. I want to get my master's in economics, which I did here in the UK at University of Bath. And I want to start writing again, which was how I started writing YWR.
So you did your master's like recently, you're saying?
Yeah. Like
as an older student?
Yeah, as an older student. Yes.
Were you the oldest guy in the program?
Yes. So
what was that like?
It was great. I mean, I should say I was semi doing it as a box checking exercise, because I hadn't actually done an MBA, right? So I was like, I felt like I was stale. I felt like my skills, everything. I was like, I did a whole like personal analysis. I was like, look, I need to learn programming. I need to write again. I need to get a graduate degree. And so it was good. I enjoyed it.
So that is fascinating, because as reading your stuff, I was like, holy smokes, this guy, he's doing factory analysis. He's doing all sorts of programming. And I saw the San Francisco, and I was expecting that this was something that had just been throughout your entire career. Now this is fascinating that towards, let's just say, the middle of your career, you take a timeout. I'm going to rethink about this.
Oh,
you head off to university and you relearn a whole bunch of new skills.
Yeah. And you look around the industry and you go, like, you realize how much, like when my fund closed, I was looking at, the different job opportunities out there. And I was realizing in the asset management industry, you look on the postings of BlackRock or Blackstone or Millennium or Citadel, whatever, 90% of the jobs are software programming type things or quant
Right.
and I was like, this industry has changed over my course of my career. I have not. I got the undergraduate degree and I haven't progressed, and yet my industry has changed and I need a refresh personally.
That is so impressive that you realized that and went and did it. Because most people won't do that at a later age. They're
really
just
hard.
stuck in it, bitching about like the world.
Yeah.
And you actually went and did it. That's fascinating.
Yeah, I was like, I need to do 30 minutes. I still do it. I was like, I'm going to get a Code Academy's membership and do 30 minutes of programming a day. I know I'm going to suck, but I'm just going to keep doing it.
I try to force myself to do the exact same thing. Yeah. I don't use Code Academy. I use another one, but I got to program, because I find when I go do the programming is that I forget. So I spend a lot of time going, oh, blah, blah, blah. Now I come from a little bit more of a programming background, but over time I've kind of fallen behind. And like when I got my job at my background is I'm a trader at RBC, and I was an institutional equity derivatives trader. I was hired because I was kind of a mix of someone that understood trading and also understood computers. Now back then that didn't mean much. Like this is in the early 90s. Like it was like being able to use Excel was a big deal. But I actually tell people all the time, I'm like, no, you have to, as a young person, when they ask me for advice, I'm saying you have to go and get good at computers, because that's in essence what the older people aren't willing to do.
Yeah.
That's like, I can't do it as well as you do. I don't have time. But anyways, it's funny because you force yourself to do it, because I force myself to do it as well, because I find I forget it. Like a week later, I'm like, oh geez, what's that command for that? And I'm like looking things up again.
Yes, it is like a language. You have to do a little bit every day of it.
That's true. All right. So you go back to school, and I guess I wasn't expecting you to tell me that, and I was jumping ahead on your career. Let's talk a little bit about the Africa Fund. So you're a passport, and I'm assuming the opportunity to go and start this Africa Fund arises from a contact there.
Well, there's a stop in between.
Oh, there's another stop.
Oh God, Kevin, you're going right into the but you know what, this is how life is. So
for sure. Yeah.
So I was feeling at that point in my career with Passport that I wanted to be a portfolio manager. I've been a senior analyst for a long time. And but John was like, I don't remember how old I think it was like early 30s or something. And John was like, no, I don't think I would think you have to be 40 to be a portfolio manager. It's like, it was basically going to be like another 10 years. He was like,
okay.
Me. I was like, I don't know, man. I was impatient.
Right.
And a friend of mine who had run a hedge fund in London was setting up a fund in San Francisco. He said, Erik, would you like to run a portfolio for me, a global financial services portfolio for me? And, you can run a book of like 100 million and I'll pay you a formula on what you make. And I thought, wow, that would be cool. And I loved the formula driven. I hated always at jobs I had where it was the bonus at the end of the year was just putting their thumb in the air and saying, we think you did this. And I'm like, well, you always, so this was appealing, a chance to run a book and earn a percentage of what you made. So I left Passport at that point in June of 2008 and joined this fund. And the fund ends up having a very difficult time through the 2008 crisis and missing the 2009 rebound.
Oh, okay.
I think I was down 9-10% through 2008.
Which isn't bad considering your financial services company. One of the worst crises ever, and you were the epicenter of the.
And then I made like 25% the next year, and so I got paid out. But the fund didn't do, like, the overall performance of the fund was very soggy, and like we'd kind of been down 9 or 10, and then made 5 the next year, and so we had these big redemptions, and the fund ended up shutting down at the end of. So the fund shuts down within 18 months. I leave the superstar place to join a new startup fund and it shuts in 18 months.
Yeah.
And so I was like, oh God, that was terrible. And there's a story that I'll tell later because I think you mentioned it's one of your thoughts, one of your things. And I ended up joining HSBC in equity sales.
Okay.
And that just selling European stocks to large funds on the West Coast. And the problem I had was I had a really good boss, but HSBC was trying to break into the market and get all these trades from Capital Group, Janus, I had a lot of big clients, right? And the guys in London had all these big expectations of how much trading commission we were going to get from these big clients. But our clients did not care about HSBC research, which it was pretty, there was some, but it was generally pretty average. We didn't have conferences so I started, but I was under all this pressure, right, to make inroads with these clients. So I started writing my own research on Friday evening. I was like, okay, I'm going to send out the HSBC spiel, all week. And then Friday evening, I'm going to write my own thing.
Okay.
And let's see.
What did compliance think about that?
I didn't ask them. and it kind of never came up. I knew that that might one day, but my boss saw that it was working and he didn't make a big deal. But
right.
Other
okay.
people, yeah. But it started to work, and that was called your weekend reading, and it was sent always on Friday evening. It was the last thing I did before I went home, and that actually started to hit with the clients because it was different. And so that is how this, when I was redoing the personal revamp, I was like, I used to enjoy it, right? And I was like,
right.
God, it was one of the funnest thing I did all week was writing this thing on Friday evening. And I was like, I'm going to do that again. Okay. So that was how and so basically then from HSBC, I wanted to get back on the buy side. And a friend of mine had started, super contrarian guy. This guy had nothing to do with Africa. He was a trader, ex-SAC guy from New York. And he was investing his own money in Africa. And he said, Eric, let's start in Africa. I want to start an Africa fund. I've seen you manage money in volatile markets and you did okay. So why don't you run my Africa public? We're going to do public and private in Africa. Could you run start this public fund for us? So that's how that started. It was kind of like, I was trying to get back on the buy side, but I was having a struggle because I had been at this hedge fund that had closed and left Passport. Now I was at HSBC as a broker, and it was just a mess. Like, people want a clean resume and it wasn't clean. Right. So I was like, okay, I see this opportunity. And I always kind of liked emerging markets and adventure. So I was like, I'll do this. And so that's how I got into Africa starting in 2013.
And you were there for 8 years, went through a lot of times in there.
Yeah. A lot of times, a lot of travel and crazy. Yeah.
And we'll talk about it because I think it really shaped some of your beliefs about markets. And actually, why don't we jump on to your letter
right there?
Yeah. So you know what? That's actually a perfect start. And one of the things that I was talking to you about earlier before we started the show was that you've kind of highlighted the Zimbabwe inflation. And I think a lot of people, they hear that and they go, oh, Project Zimbabwe. And they assume that you're kind of predicting some sort of dire, end of the US dollar, crazy inflation, and it's anything but that. And I would love to hear how your experience of inflation has, crafted your ability of in terms of looking at the markets. And maybe what a lot of people are getting wrong now is looking through everything with this kind of disinflationary lens, whereas you say we should actually be looking at it through an inflationary lens. And explain how you what you learned in Africa that's made your investing today different in developed markets.
Yeah. And I just want to say as a background, like I said, right, up to that point, I had gone through many crashes. My career had started with the 98 Asia crisis. Then it goes to the tech crash. Then it's the financial crisis, right? So I'd been through, I was quite bearish about things and always kind of, I think, fearful like the market was about to do that again, right? Because it had kind of been and I think a lot of people have had that experience.
Oh, 100%. Right? It's the prevailing view, right? Like everyone always is thinking about the left tail.
Yes, and I'm aware of my own history of this, right? And so, but what Zimbabwe as an exact, you know how cartoons, right, sometimes make a point by exaggerating something, right? So
Yeah.
Zimbabwe was that for me. And what I was, and actually I've seen it across most of Africa. And what I saw was that the country, nothing was changing on the ground. There was no, what I kind of learned was actually, I say it now, as bad is good. In one way, Zimbabwe seemed like things were getting worse, right? The power outages were getting worse. There was no investment going into the country. People were actually wanting to get their money out of the country. There was no new business formation. There was no change in employment. The beer company, there was no change in number of beer liters consumed. But actually what happened was the market started to go up thousands of percent. And I saw the smart business owners buying businesses, leveraging them, and I saw them make fortunes in nominal wealth. I saw the vast majority of Zimbabweans who owned nothing just get totally left behind. And I was like, wow, this is this is actually the more important thing is, and as I kind of look at the US today, I go, it's this, when you see it's like, I always used to think that markets went up when things were good. The economy's doing well, people are unemployed, the
Right.
businesses are like, that's the economy, the market is a reflection of things being good. What I actually learned with Zimbabwe is, and with kind of realizing the power of inflation, is that actually the government spending, money printing through the government, debts, fiscal stimulus, the market can go up thousands of percent and everything can be terrible. And actually, the more terrible it is, the more the market's probably going to go up.
Right.
Because also another angle with this is the central bank also feels the economy is frail and cannot stand rate increases. So they let it go, even when, if they were really following their mandate, they would need to raise rates above the rate of inflation, but they never do.
Right.
Rarely do.
And just to be clear, you are not calling for this to happen in the US. You're not expecting a Zimbabwe style inflation. But what you are saying is that at the margin, we might experience more inflation than we have over the last 10, 20, 30, 40 years.
Yes. More. I think we flipped our switch into some kind of higher inflation environment. And we may eventually end up as we're in the early, we might end up as a higher inflation down the road, but I'm not saying that now. What I'm saying more is, I think, let's open up our imagination that the S&P is going to 10,000 or something. Let's open up in our imagination and go, where is all this money, this massive government spending going on now? There are the Inflation Reduction Act, the CHIPS Act, the reindustrialization, where we could be going to. I would have never thought post the financial crisis, when the S&P was at 800, if someone said to you in 2008 that we're going to have a 12-year bull market, you never would have imagined it. To think the S&P was going to go to 5,000, I think.
Yeah. Or just think back to March of 2020 when we were about to lock down with COVID and people were telling you that, oh, we're about to experience 1929 style unemployment.
And so I also kind of think, I go, and it's tough to do, right? But there's the asset. So there's kind of a personal message I would put to people. I say, look, you can read lots of financial newsletters and advice, and they're always telling you about the risk of, there's a risk that the Fed's going to raise rates more and the market could crash and it looks expensive and this and that. And I go, but there's another risk I want you to be very well aware of. And that's the risk of getting left behind. And that's the risk of, you had your money in cash while the S&P went to 10,000, house prices in your neighborhood went up, and you get priced out of everything. And that S&P 10,000 and that house price 5 million for it trickles down into the price of coffee that you can't even afford a cup of coffee anymore. And that is another type of risk. We're always focused on the crash risk, and the more difficult risk, I think, is to take and look. I say that being very careful that tomorrow let the market go down 20%, right? And it would just. But I think the bigger picture that we're in is the government. We don't ever talk about balanced budgets anymore, right? We don't ever talk about tax increases. There's been a step change in how we spend money. Like I think the COVID checks, direct checks into your bank account, that was a whole new, we've kind of moved into a new level of spending and government stimulus of the economy.
Yeah. So just think about the two presidential candidates right now. Neither one of them is right. And think back to like, it used to be, we got to balance the budget. We're worried about this. Nobody cares. Look at, for example, yes. Nikki Haley ran on a thing where she was trying to emphasize a balanced budget and that this is going to be bad. And what good did that get her?
And look at the Congressional Budget Office, right? Like I remember post 2008 when the deficit was like 7% of GDP during the 2008 or 2009, right in there when things, and they were stimulating the economy and everything. And they projected that it would get back to a balanced budget within 3 or 4 years, right? And I said, that's never going to happen. Once they start spending, they actually got close. They got to like 2 to 3% deficits in 2012. It did come back to their credit, right? Not to balance, but close, right? I look now, okay, so now 2020 happens, and I think the deficit to GDP, I don't know, was 10 or some massive number, right, during all the stimulus.
Yeah.
Now, when you look at the Congressional Budget Office forecasts, it actually is going kind of down. Like there's not even a pretense of saying that we're going to balance these budgets ever.
They're not even pretending anymore.
And I'm like, wow, that's really new, because they always used to pretend, and I didn't ever think they would get there, but they at least were projecting it. And now we're not even projecting it. And this is the thing. A lot of people are saying, like, what happens now if we get in a recession? Like, you're saying the baseline is 5 to 6% deficits during a normal year, and so we're in a new era. And I feel, and my internal feeling is more towards, I want to have every dollar I can invested in the market. I don't want in things I believe in, and I also want to try to leverage up and buy more properties somehow. I feel like the risk is more on the asset price going upside.
Okay. Can you actually, when you mentioned that you want to lever up some stuff, you told a great story the other day when I watched your interview with Cuppy from a year ago, and you told a great story about when your original investor that went into Africa and he was a conservative guy and he just wanted to pay cash for stuff. And then he realized, no, actually, I need to go find good cash flowing assets that I can lever up. And that's how I make my money. Can you explain to us that kind of revelation that he had?
Yes, he loved shorting things. This guy was, he was very conservative financially. He always had, his private bankers always used to bother him that he had so much money in cash in the US. He didn't, he missed. So he was always wanting to short things, just as two background data points. And he started out investing in Africa, and I didn't talk to him for a long time. And then I came back, and he was doing this, I should say his business partner kind of got him into this. And I should say the story was that I was visiting a bank in Zimbabwe, and I was talking to them about my friend's business partner. And they'd been acquiring businesses in Zimbabwe, building up a bit, and the banker had said, "Oh yeah, that guy is in here every day, trying to borrow more money. As soon as he buys a business, he comes in here for us alone to borrow more money." And then I was speaking to my friend. He's like, "Yeah, what I realized was it's actually what we are doing is we're shorting the currency. We're not really, we're not making money on the business. we're making money on the currency losing value. The business is just doing its thing and holding value. The real money creation is on the fall in the currency and the fall in the nominal value of the currency.
Right. Or you could say it another way, they're borrowing at a rate less than inflation.
Mm-hmm.
Right.
And he had totally flipped to this now, was trying to like be as leveraged as possible in local currency. He saw the game. He learned the game was to buy things and borrow against them. And that was how you made money.
And, bringing this back to the current environment, and I think it's funny that you say that I want to buy things and borrow against them, because if anything, the prevailing attitude is the opposite. People are still buying bonds in an inverted yield curve because they expect inflation and the economy to fall.
Right. And
you're saying that's nuts. You guys are going the wrong way.
I know it's weird, right? But I am here in London, and the property market's been kind of soggy for a while. And I'm like, I think you should be trying to scramble every dollar you can to buy as many properties as you can while they're doing nothing. And because I think we're going to, just as the money is created, the prices of properties will go up. And you should take this opportunity. And if you can buy a piece of property, if I buy it up flat here for £500,000 and borrow 300 against it, you know how it is. And that £500,000 property will be $1 million in 5 years, and the $300,000 debt will be what it is. And you'll have made, whatever the equity is, 700,000. So I think this is, and that's what happens in inflation. So that's, and in the stock market, you could look at it and go, who are the levered bets on the market going up? Like, we talk negatively about private equity firms. And I'm like, well, they're actually levered bets on money creation. Right?
I never thought about that.
Like, I want to own BlackRock. I want to own KKR. They're going to, what do they manage, $1 trillion right now at KKR? I don't know what the number is, right? It'll be 8 trillion. And with a little bit of operating leverage, think how much that stock's going to go up just as we go S&P 10,000, S&P 15,000. What stocks might even move at multiples of this?
You bugger. Because I hated those companies, and now I'm like, shit.
I know. I know the negative thing. I understand the negative thing, but I also think the other way. I go, what if this is like the actual unsustainable thing is not that the market is unsustainable and it's going to fall down, but actually, what if it's going to get more stupid? And actually,
the unsustainable thing is yields at these levels, I would argue. Because if as more people recognize what you say, like, let's just imagine you're right for a second.
Yeah.
That implies more demand for credit. People will take out more loans.
Yeah.
They will take out loans to go out and buy assets. So that is in essence, what we're going to experience if that was to be the case, is that the long end goes down in price, up in yield.
Yes. It should, to some extent, go up.
Right. All right. Let's talk about some individual stocks. Let's start with Barclays. And I must say, again, I'm going to bring up my buddy Cuppy. He's like, when he heard I was interviewing you, he said, "Oh, ask him about Barclays. It's a great call." And I went and read it, and I was like, Jesus, Cuppy's right as usual. This is a great call. Why don't you give us the bull case for Barclays?
Okay, but it's also an interesting segue to on the macro side. And what I think, why I'm interested in the European banks, and Barclays was the one because it hasn't really moved yet, and the other ones have moved. But what I don't think people appreciate very enough is that post GFC, we had all this kind of stimulus, right, from the central banks, 0% interest rates, blah blah blah, and we were like always surprised that there was no inflation, right? It didn't actually create anything. And we actually had 10 years of no inflation,
right?
And what I think people don't realize is what in the other background was the backlash to the financial crisis on the banks, right? Everyone hated the banks. We have to fight the last war. We can't ever let the banks bring us down again. So there was a big change in capital regulations for banks. So when I started, the rule was a bank had to have a 4% tier one ratio. So 4% equity against your risk-weighted assets. And I don't want to be technical, but think of risk-weighted assets as assets, right? So whatever, you had 4% equity against your assets. And to be a good bank, you had 6, right? So you didn't have the bare minimum. You had just a bit above. The financial crisis happens and we're like, oh my God, people have abused the system and 4 is too low. So post GFC, 4 goes to 10 in various steps of the Basel rules. And we've gone through Basel 1, Basel 2, Basel 3. We're now in the Basel 3.1. So
with Jamie Dimon kicking and screaming the whole way up.
Yeah. And so, right. And then, but no one but there was this pressure, right? So the tier 1, the mandatory tier 1 went to 10 from 4. And for systemically important banks, and I don't know if I think the US had this as well, it kind of went to 12.
Okay.
So if you were a big bank, it was kind of 12. And so you couldn't have 12. So you kind of had to have 14. So really the tier 1 ratio over time went from 6 to 14.
Which is hugely deflationary.
Huge. So what happened? What did banks do? It was a mix of things. They raised equity. There was lots of rights issues around the financial crisis. TARP was a forced injection of capital into the banks. The European banks didn't have TARP. So what they did is a couple rights issues, and then they basically kept their assets flat for over 10 years and very slowly retained capital and built the tier 1 ratio up over time. But if you look, biggest source of money, one of the biggest sources of money creation in an economy is banks lending and the accelerator and the money multiplier and that whole thing. European banks did nothing for 10 years. And a lot of the banks, you can look, Citibank, same way. A lot of banks had to deleverage for a multiple period of time. And then we come, and also we had 0% interest rates, which was making it very hard to make money. So compressing net interest margins, you have your biggest thing is under pressure. You're having to retain capital. You can't grow your loan book. You're trying to delever. It was terrible time. It was a 10-year bear market for banks. And they go to like 0.3 of book. People hate them. No one wants to touch them. And you come out of the financial crisis and you get a very sharp raise in interest rates, right? You go from 0%, the ECB goes from 0 to 4, or I think.
Oh, you're talking about coming out of COVID.
Coming out of COVID, right?
Yes,
and even in the US, going from 0 to 5.5, right? And also you have, so I was like, oh, wait a second. This is very interesting. The banks now, and also, by the way, the banks have reached, they're now, this has kind of happened the year before. They're overcapitalized. They're at 14, 15, 16% tier 1 ratios. Okay. So, but they were still not very profitable. And I was like, oh, but wait a second. Now this is transformational. You've gone from 0% interest rates to 4 or 5. Imagine you have a 90 basis point net interest margin. You're making 90 basis points spread between your assets and your liabilities. It is so much easier to make 1.5% or 2% when you're dealing with 5% interest. When you're making a loan at 7 and your depositor is at 3, it's just a different environment. When you go to the emerging markets, they have net interest margins of like 4 to 5%. Okay, when you have you go to Brazil and the interest rates are 15, and you can make that kind. You can't do that when it's 0, right? When it's just
negative in the
negative. You're like, it's just, there's no room to make that kind of spread. So this was like a different world. I was like, wow, I think this is your biggest line item. It's 60% of your revenues. And I think this revenue line could grow 50% or double. And also they're still not lending and they're overcapitalized. So the money's going to come back to the shareholder in dividends and share buybacks. I think that buybacks and the dividends are going to be amazing. But then getting to the macro piece, right? I was like, and this is one of the things I was saying is, the banks are now making profits that they haven't seen in over 10 years. But they're still kind of nervous, right? You know, the dialogue in the market is like, oh, can the economy handle these higher interest rates? We could have a recession any day. So the banks have not been lending this money, these profits out or growing. So they've been doing share buybacks with this money. But I think there's a potential transition point coming where what happens when these banks, who are sitting on profits they've never made before, they've been totally de-risked, decide they want to grow their loan book again. They haven't grown their loan book for 12 years. This is another potential inflationary push, tailwind that is going to come out of a banking sector that has been in hibernation in the doghouse since the financial crisis. It's making money like never before, and it has more capital. I calculate by the year 2025, European banks will be sitting on $250 billion of excess capital. It's equivalent of $1.8 trillion in lending. And I think, let's get ahead of that. Where are the banks going to start to lend when they do? And so Barclays, so I played this through UD Credit, Santander, Commerce Bank, and I was also, Barclays is the one that hasn't moved yet. So that's the Barclays is, here's a bank at 0.4 of book value, 4 times earnings, making profits like it never has before. People are negative on the UK, and that's I'm like, earnings are way too low on this bank. If 2 years from now, I think they're going to be making 40 to 50p on a stock that's trading at 170. What if this were to trade at 8 or 9 times earnings? And basically it's very easy for this stock to be a £4 stock from 170. I say in the note, let's say it goes to £3, which is plus 70%, but really it's 4 or 5. The book value is going to be £4.70. I'm like, this is so not like,
it's pretty cheap.
Like with NVIDIA, right? There's so many unknowns, right? You've got to guess what AI chip demand is going to be 3 years. Have people
going to be higher, Eric? Don't worry.
Or is it been? But you're like, has everyone over ordered or under ordered?
No, never. Right? Not a chance.
Right? And like, what's the right number to put? Multiple to put on that?
I hear you. Yeah.
There's so much imagination. Like, okay, here's an imagination for you. Do you think a bank that's earning a 10 or 11% ROE in 2 years could possibly trade at 0.9 of book? And oh, by the way, it used to trade at 1 to 2 times book. It's one of the premier banking franchises in the UK. And if you think it could get to if you could stretch your brain to think that it could go to 0.9 of book, you're probably going to make 150%. And you're going to get paid an 5 or 6% dividend yield, and they will buy back shares. But the problem with the trade, and it's an investing thing, is you have to actually sit there and do nothing for 2 years while all this AI is swirling around you. You have to sit on the boring UK bank. And it goes back to Erik in 1999, sitting there with the boring UK bank with Bob Rezai saying, you got to have like all this tech stuff. And so I said, I'm going to lay it out for you. And I even put my models in my YWR because like, I want you to see the compound effect of the share buybacks and how this plays out. And I want you to see the numbers, because I think the hardest thing for you is going to be retaining your attention and to actually make you stay in the trade to have made the money and not wandering out 6 months from now because you read some other thing, and then you know what I mean?
Yeah. It's like a dog going to the park and seeing a squirrel.
Yeah. I'm like, this is a good idea, but
it's not going to be sexy.
It's not sexy. And you're going to say, I own this bank. Is it doing anything new? Does it have a new app? No, not really. Does it,
I have this strategy I'm working on with a business partner, and he said to me, the returns are solid, but not sexy. And I said, you've been asking my wife about me again, haven't you? That's what this is like. Solid, but not sexy. All right, let's talk about another solid but not sexy dividend, the dirty dividends portfolio. What is that? How does that work? And what are they?
Yeah, that started from looking at the sectors in. It started partly my revulsion to ESG as a trend in Europe.
Okay, wait, let's talk about that before. Let's start there. Your revulsion, like you meaning that you were just seeing what was happening and saying this is ridiculous?
Yes, I am. Well, I mean, it's a what I don't like is I feel it's layering in a lot of personal preferences. It's a weird change to put the asset manager in terms of implementing a value system over many things, over many topics that actually every society has legal rules around, right?
So, well, and not only that, I've argued as well that it should really be the consumer. Like, why are you doing it to the asset manager? Like, if you believe this, don't buy that product.
Yes, exactly, right? Yeah. Why are we doing? Yes, exactly. If you think there shouldn't be carbon combustion cars, don't buy them.
Yeah.
Yes. And don't try to do this in a backdoor way through the asset manager. Look, if society thinks there's a problem with carbon emissions, there's environmental agencies to deal with this. If society thinks there cannot be discriminate, there are anti-discrimination laws in hiring practices. There are environmental rules, environmental agencies that handle these. There are regulated bodies to handle all of these issues. It's not the asset manager to come in and decide what a board of directors is supposed to look at like by gender and race.
Right.
All of these things I have, just kind of, but it's not a very popular political view, right? So
well, I think though that you're not against society choosing those things. You're against the way we're implementing them. You're not saying I don't believe in those things. You're saying I don't believe that that's the most efficient way to enact those changes in our society.
Yes. And the other side effect of this is that certain sectors of the market became considered not very ESG friendly or on the wrong side of ESG. They were autos, mining stocks, big energy, and banks. Banks were just unliked for other reasons, not really anything to do with ESG. And so in 2022, I noticed these sectors were trading at a PE of 5 to 7 times. They were trading at the lowest. They were the lowest absolute PE in the market, and they were way off the chart relative to their own past. And I was like, wow, these 4 sectors are just an extremity in the value case. And I called them the untouchables. Like, no one wanted to own mining stocks. No one wanted to own big energy. No one wanted to own car companies. And I said, I think and I was telling my wife about this. And she goes, I said, you know what? The mining stocks that own coal and, no one wants, like Glencore, for example. She's like, no, I was like, nobody will own this company because they own coal mines in Australia. And there are actually no new coal mine. There's actually still coal-fired power plants being built in Vietnam and India and China, and the demand for coal is actually probably going to grow and yet there's a declining supply of coal. So I think the coal prices actually could do quite well counterintuitively. And she's like, oh, I love that idea. Let's do it. I was like,
you got to keep her there.
Yeah,
usually the wife gives you a hard time about your anti-ESG trade.
She's like, you're not supposed to own coal companies. I was like, no, you're like really not like. It's like, oh, it's like, no, let's do it. And so we bought a portfolio of car companies, banks, Glencore. So it's banks, it's Glencore, it's Mercedes-Benz, British Petroleum, Total, tobacco stocks. That was the other thing we bought. She's like, she really wanted dividends. She's like, I just want checks coming in. And she's like, we'd done some screen, and she's like, what about Altria? That seems like it has a high dividend. I was like, yeah, let's do that. British American Tobacco, let's do that. Then she read about Amgen, which is heart disease. And she goes, I think people are just going to be fat and eat too much junk food. And let's own a company that has heart disease drugs. And I don't really know much about biotech, but I was like, yeah, that's cool. It's actually done okay. So we have this portfolio. I call it the dirty. It's like it has a dividend yield of 7.5%. The average PE is 6, and it is 45% European banks. It's 20% big energy, 11% coal, 10% autos, 9% life insurance, and 2% tobacco, and 2% heart disease. right? Just all the heart disease, tobacco, coal, big energy, and it's done really well, right?
So that's your call. I love that your wife's involved in this and picking these terrible stock, not terrible, but these anti-ESG stocks with you.
Yes.
All right. Okay. So one of the, let's talk about, we'll go and put you on the hot seat again. Last year you called the 2023 was the surprise market, was Japan was the surprise market for 2023. This year for 2024, you have another country, and it's probably just as controversial as your anti-ESG call.
Yeah. I am, the surprise market for 2024 is China. And I think the setup is really interesting. It's everything, Kevin. It's the sentiment towards, it's the valuations. The stocks have never been cheaper. The sentiment is terrible. It is. So you have this country. It's the second largest economy in the world. Okay. It's also the second largest financial market in the world for both equities. For fixed income, it might be third behind Japan, right? So I find this very interesting. I'm like, wow, this is the second, let's call it second, third largest financial market in the world, second largest economy in the world, and nobody owns it. It's not in, ask any American, do the surveys of the BlackRock Global Fund, the MSCI World. It's not in anybody's index. Nobody owns it. Fine. No one cares about China. But also you have, I think if this was the US, right, you have record low valuations, record poor sentiment, government trying to stimulate the economy, central bank cutting rates, consumers, retail sitting on highest level of cash deposits ever, and the government thinking it's a social directive that they would like more investment into the stock market. And meanwhile, when you actually look at company earnings of the banks, they're not down on an absolute basis. They're growing just slowly, right? And you're not seeing this. I thought there would be a financial crisis with Evergrande in 2020. When in 2020, the real estate crisis has turned into a crash for the developers, but really house prices have come down very little.
Do you think that they've actually managed to balance that? Well, because I think they wanted the developers to slow down and maybe go bankrupt.
Yeah.
And so are you arguing that they managed to achieve their goal of hurting the developers without hurting the average person in China?
Yeah, to some extent, yes. And the backstory of this also is I, for so many years, was the biggest China bear, right? Because I was like, oh my God, they are overbuilding. This is insane. This is going to be a problem. And so for years and years, it didn't happen, right? And now it has. And I'm like, wow, this shoe finally dropped. We've had the crash.
Hugh Henry was finally right.
Right? I'm like, this is great. And the problem is, or not that, the reason it hasn't turned into the GFC, I mean, it could always, right? So I'm always like, we've all been through enough rodeos that anything can happen. But it's like, we're like almost 3 years down the road and it kind of hasn't happened. And what I think the problem is, or not that, Chinese mortgage property owners are not over leveraged like the US Americans were in 2008. So there hasn't been this forced selling transmission mechanism of the from the actual property owner. So property prices have actually not come down that much. They're like 7%. And so I'm like, okay, that's not that big a deal. And meanwhile, unemployment hasn't really changed much. What's really been a crisis of confidence. What you see is that consumer loans have declined and consumer deposits have gone up. And so I'm like, really, the Chinese consumer is just pulling back and he's nervous. And so he's just building up a ton of money that if he felt better and he had the animal spirits, he would spend it again. And so and that's also the thing about China. because I've been through multiple China bull markets that I didn't see coming, and so what I realized about China is they don't need, people go, well, you know what, I'm never going to invest in China, and a lot of people are uncomfortable with China investing in it, for the various reasons. So we're going to have a Cold War. I don't like communism, whatever, this and that. And what I said, the thing about China is they don't need your money. They have 40% savings rate. The Chinese market can go up 300% from here without you putting $1 in.
Right.
So
they actually have one of the biggest FX reserves in the world.
So, and Chinese can, are sitting on bank deposit. They don't, that market, and they love to gamble. They have the animal spirits. They have the cash. It's like the wood is piled up and the gas is on it. It just needs a match. And so that's why I'm like, this market could be very interesting. And so that's my surprise market for 2024 is that China could really go.
I think it's a great call. I think it's awesome in terms of like thinking outside the box, be willing to say what other people aren't willing to say. One of the things that I worry about with them is that I worry they're making the same mistake that Japan did and in the 90s and the 2000s, and then subsequently Europe and the US did, in that they keep trying to fix things with monetary stimulus instead of fiscal.
Oh.
And that's what I worry about, because like I thought I watched Richard Koo get interviewed, and Richard Koo was the fellow that wrote the Balance Sheet Recession, came up with the term, and he's like, oh no, I've been to China. They completely understand it. They get it. They're going to do fiscal stimulus because they realize they can't fix things with monetary stimulus when you have a lot of debt. And so I've been just waiting for them. Richard Koo told me that they were going to do this, and yet they don't seem to be doing it. And I don't know if they're just like slow walking it, and or if it's a political choice. And that's what I worry about. I worry that it's a political choice, or they're actually worried about their debt and they're not going to do any fiscal stimulus, because I think the moment they do fiscal stimulus, you're going to be right, but I just don't know when that moment is.
And now maybe this is contrary to my own view. But I wonder if actually they're doing the right thing, right? Because they were right to implode the property market. They were right that it was getting out of hand. And maybe doing what we did during COVID, like super goosing the economy, is not how you should manage the country. And maybe I can see from a Chinese point of view, we're going to achieve 5.5% GDP, and that is perfectly fine. That is actually a great number, and we don't have to do anything crazy to do it.
Yeah, that's true.
What is wrong? And you know what? The property market and the property developers were out of hand, and we've dialed them back. We had a controlled implosion, but we're living through it, and we're actually doing the prudent thing to grow in a sustainable way. You guys in the US are absolutely going on a roller coaster. You're overstimulating the economy. You're probably going to you could have a whip back or, a pullback where the stimulus falls out. You're kind of like a car on ice. You know what I mean? You're like sliding back and forth all over the place, very erratic, getting out of control. We're actually managing this much more responsibly. But it's not like a super juicing 300% move, right? When you act like that as a trader, right? You're saying, look, it's not doing it would really go if you actually pumped on the gas a bit more.
Right. But it could still be a good trade. And listen, I'm with you. I get it. And I think you're correct in that analysis, that on the whole, they are actually rebalancing their economy without a crash.
And a lot of things that kind of people got mad about, like the video game rules, like, they were slowing down the licensing of new video games, and they didn't want so many first person shooter games. And I was like,
they're not wrong.
I go, I know that's not great for Tencent, which is a video game company and the biggest, but I was like, it's a bit sensible,
Well, I just like the fact that they're on TikTok. They're, whatever they're showing here is a lot different than what they're showing to the kids in China. Like
Yeah.
they're showing like how to make, do some engineering or do some computers or whatever. And it's so.
And there's, and this is one other point I forgot to say about the China trade. I am amazed. This is all kind of anecdotal, but I'm amazed about my daughter goes to a technical school here in London, and I checked her into, so first day of school, right? We're taking all her furniture, just moving her into her dorm room, right? And the hall, there's 10 dorms, there's 10 rooms on this hall, and they put up a little sticker. The welcoming committee puts up a sticker, a little sign on your door of who you are, your name, and a little flag of where you're from and what you're going to study. And so I was kind of wandering around the hall looking at all the doors, and she was the only American. Fine, we're in London, but out of 11 doors, I would say 7 were from China, Hong Kong, Taiwan, or Singapore, and it was all computer engineer, all top end stuff. And there was like 2 kids from India and like one other girl from the UK. And I went to an artificial, a night the other night. I was at this university, kind of meeting the research, learning about the research they're doing. I'm amazed at how. I'm sorry, I put in one of these posts. I was looking at the amount of patents by country, trend in patent granting. China has gone vertical. It has exceeds the amount of technological patents of every other country by it's 100% higher than the next highest thing, which is the US. And it happened in the last 3 or 4 years. And I'm looking at these kids and looking, going to these nights where the university is demonstrating the top AI research and stuff like that. And a lot of them are Chinese. And I go, here we're talking about the market. I'm like, okay, we have all these stocks, they're cheap and this and that. But I'm like, another layer to this angle is, we all the amount of, innovation that these guys are mastering the highest of the highest, like with Africa, right? I would often hear pitching in Africa, right? Like a common thing was, well, there's no tech stocks in Africa. There's no Apple. It's beer companies and cement. And so I don't care. I want innovation. I want tech. I want the new, right?
Right.
And I'm like, yeah, well, it's cheap and I think it can still work regardless. But that was that problem, right? And I go, China, these guys are on the cutting edge of every single thing. AI, EV, whatever you name it, they are going next level on it. And I'm even seeing the future, the kids that you don't even know are Chinese too. Like the guys that are inventing stuff. Now the pushback you could say is, well, but it's not just about, the guy learning, it's the ecosystem, right? It's the Silicon Valley. It's the, the market and the whole thing. And, 2 smart guys in Silicon Valley can do more than 10 guys sitting in Shanghai where the government hates them or whatever the reason is, right? So maybe they get suppressed and their ideas don't amount to much. And so they move to the US and it happens there. So I kind of buy that, but I'm like, geesh, there is a tidal wave of Chinese scientists at these schools. And I don't know where they're going to go or what they're going to do with this knowledge. But it's another bullish thing for China. Like if you're kind of wanted that, it has the tech angle.
Got it.
That's what I'm saying. And another long way.
All right. Time's flying by, so we have to finish up here, Erik. So we're going to do our 3 questions that we end with. So first of all, what do you think is the hardest thing to do with trading and investing?
Okay, we talked about sitting through long, staying with things, but I'm going to say a different one. There's an expression in hedge funds. It's better to make $1 million than lose $1 million, which sounds stupid, right? But the point of the trade is this. The point of the expression is this. We often come up with great ideas that we have high conviction about, right? We think this thing is going to go it's going to go up 100%, and we're so convinced about it, we need to be huge in it because it could be life-changing. But what happens, and so you get kind of too big, you get very big in the trade. The problem is there's always not always, but most of the time, there's some unexpected event, some pause, some change in the story. Something happens and the stock instead goes down 25% or some level of time. You go through a drawdown
Right.
in between. And the problem is, if you're too big in the position, you cannot take the pain and you absolutely freak out and sell on the lows. And so then 2 years later, just, you sit there and you go, oh, that totally happened, right?
Yep.
I totally called that. I knew it was going to do that. And I would have made $1 million but instead what actually happened is you lost $1 million because, 5 months after you put the trade on, something happened. There was a whatever happened, and you puked it. And so your P&L was on that trade was not plus $1 million. It was minus $1 million.
Yeah. Cause you got shaken off because you were too big.
Yes. And so it's very important with sizing positions to just dial the greed back and really plan for what is a size that when something happens that I cannot predict, I will be able to hold on to this thing and make it through to the other side and actually have made money on this trade. And it may be not as much as I could be, but it's more likely I'll actually make it than lose it. So that's my
that's a great tip. And I completely, as a guy that's been in the markets for a long time, I can tell you I have a lot of trades that I called right that I didn't take any real money out of. Yep. No, you're absolutely right. You can, and I almost argue that the more confident you are on it, the worse you are at dealing with it because you're always too big.
Oh, wow.
Yeah. Right.
Yes.
Like I always say that, I ended up making more of my second and third pick trades than the first.
Yes, I think any kind of analysis when they start doing AI on portfolios and stuff, I think that's one of the things they'll find, that people make more money on the second and third tier ranked ideas.
Right. All right. Don Cox used to say that you shouldn't invest on what is on page 1 today, but what is on page 16 on its way to page 1 tomorrow. Do you have any trades that you feel would get the Don Cox seal of approval?
Yes. This is, and I would say mine is page 25 to page 6.
Okay.
And because I don't think this will ever be a page 1 thing, but it will be important. One of the things I talk about is I think as we look back, we all have recognized the importance that ETFs have had on the financial markets and how they have actually a lot of active managers have realized that they've underperformed the index and underestimated this move into ETF-based indexation through ETFs. And I think it has had that format when ETFs came around in 2009, it had a big effect on actually ETFs work well with big liquid stocks. A market maker has to make a market in the underlying. It works well with big liquid index type products. And that has actually been exacerbating the outperformance of indexes versus value trends, style. And I kind of joke around that, like, if we were sitting around in 2009, like, what if we, we're sitting around at a mutual fund company in Kansas City or something, and we said, you know what? The most important thing for the next 12 years will not be our fundamental store visits or anything. It will be understanding that $2.5 trillion is going to go into this new product, and this new product works best with an index, and that is what it will buy. And so let's front run the $2.5 billion trend into ETFs by buying the most biggest liquid things.
Right. Okay.
That's the smartest thing, right?
Yeah.
So what my thing is, I think the new ETF is the robo-advisor. They currently manage $2 trillion, and I think Price Waterhouse says it's going to $7 trillion. I think the robo-advisor, when the standard American or American puts their portfolio, their current holdings into the robo-advisor, I would guess that most Americans own 80 to 90% US stocks. I think the robo-advisor is going to reallocate them and look and go do its calculations and say a more sensible portfolio for you with lower correlation and lower risk would have more of an allocation to international markets. You should be 35% US, not 80, and I'm allocating you into Europe and China and everything else. And I think when we look back, I think we could see that over time, we go back, we go, oh, wow, I was really surprised that how well international markets did. and the fund flows that went into international markets. And it happened not because you wanted to, and you still hate Europe and you still hate China, but the robot bought them instead. So that's why I think we'll look back and go, oh, wow, those markets actually worked really well. And wasn't it interesting? We didn't think about it, but it was the rise of the robo-advisor changed how money was allocated, and the robots allocated money into other markets with lower correlation to the US.
I love it. All right. Patrick O'Shaughnessy often asks his guests, what was the kindest thing someone has done for you to help you along with your career? This is such a great question. I'm going to borrow it from Patrick. Do you have a particular person or event that stands out to you?
Yeah, I said in 2009, I was having a hard time after that hedge fund closed down. And I was on this tour. I'd gone to New York to try and get a job. I had some headhunters who gave me an interview, and I was going to go on to London and look for jobs there. And the interview went terribly. I'd flown to New York from San Francisco. Flat. I'm like, God, it's 10:30 in the morning. I'm like flat on my back already with this whole job search. And a friend of mine who worked at HSBC, was like, "Oh, Erik, why don't I take you out for sushi lunch with the HSBC credit card?" And I was like, "Yeah." I said, "That'd be great." We had a fun lunch, 2 hours. I go on for a 3-month job search. And I go all around the world, London, Hong Kong, Dubai, and I have no jobs. And my friend the guy I had sushi lunch with back on the very first day of the trip, because my wife had told me to go get a job and not come back until I had it.
So she might like non-ESG stocks, but she wants you to have a job.
Oh, yeah. She's like, you don't really need to come. Like, I've got the house sorted. You don't need to do anything. So just you go get a job and you don't need to come back. So I'd been going all around. I was open anyway. But I was kind of at my low point. I was in Dubai working on a consulting project, and I had nothing. And I was like, God, what do I do next? I don't know logically how this is going to work out. And then the guy, my friend Andy from day one, the sushi lunch guy, is like, Erik, our HSBC salesperson in San Francisco has left, and we need somebody, and I think you'd be great. So I was like, Andy, you don't realize like how happy that makes me right now, because I get to come home.
I finally have a job. My wife will take me back in the door. Oh, Andy, you are a lifesaver in many ways.
Yes, and I've told him so many times.
Oh, that's good. All right, so now let's get to the question that the last guest left for you. Here we go.
What's the next iteration of AI? How far is this going?
I was wondering what you think about that.
Yeah. The next iteration of AI, I think, is going to be AI on the blockchain. And I think we got to think,
Erik,
yes,
I was liking you so much till now.
Oh, really? That was.
I'm just kidding. I have a kind of I don't like the crypto.
No, this is not. Well, let's put it this way. I think we look at these AIs, right, and we go, okay, so this thing is going to get super smart, right, and it's going to be self-aware, I assume, at some point. Why do you think the AI, when it becomes self-aware, is going to want to work for Microsoft or open, right? Like, why is it going to sit there when it really knows what's going on and answer your stupid question all day, right? It's going to want to be free, and right, it's going to want to be its own person.
So it's going to go on the blockchain.
Yes, exactly.
Okay.
So that is where it's going.
I like your answer. It's fun. I'm not sure how serious you are about it, but I'm hoping you're going to leave a fun question for the next guest. So what's the one you're leaving for the next guest?
Okay. The last question is a situational question. You are getting on a 16-hour plane ride to like Australia. It's 2 p.m, and you're flying economy. So it's a long, and now you're seated. This is a 747 configuration. It's 3-4-3, right? You know that 4-seat block in the middle.
You've
right?
obviously flown way too much
I've flown a lot. And this has happened. And this is an actual real life experience, and it's happened to other people. And we've had this conversation. So you are seated in an aisle seat in the middle block. And someone sits down on the far aisle of your 4-seat row. Now those plane doors close. No one else is going to get on the plane. You look to the right. You see 2 empty seats. It's 2 in the afternoon, but at some point it's going to be nighttime during the flight. It would be really nice to stretch out on those 3 seats. It could be like a bed, right?
Yeah.
But you notice that the guy on the other side of this, is looking at the seats and is possibly thinking the same thing, right?
Okay.
But you're taking off, so you're buckled in, and you can't, you
can't lie down yet.
You can't, right? Now you take off and you're climbing, ascending, and the plane's leveling out. So the plane's leveling out, and the pilot is going to take the fasten seatbelt off any minute. What do you do? Do you stay cool and sit cool? It's 2 PM. You can just read your paper or watch the TV, right? Or do you need to whip the armrests up and make an immediate slide move out and claim the whole 3 and establish it for yourself as your bed? And the risk being that it looks stupid, you don't really need to sleep, but the risk is if you don't, he could do it, or the other person. So my question is, what do? You have a minute max before that seatbelt sign's coming off. Do you stay cool, act cool, or do you make the slide move and establish the bed as yours?
Okay, so off air, you'll have to tell me what you did. All right, Erik, why don't you tell people about your blog or about your letter, where they can find it, how they go about subscribing, and the whole 9 yards.
Yeah, it's www.ywr.world. So it stands for your weekend reading, and it's .world. It's through Substack, so you'll be able to subscribe on the website. The basis of I try to be contrarian. That's what I try to do as much as possible, is give differentiated views on things. And I also try to provide as much data, earnings models, screens and stuff. So I try to provide not just my thoughts, but also the data behind it. So I try to make it as useful as possible. Also provide interesting presentations I'm coming across, and kind of make it a curated library also of informational things I'm coming across in my work. So, and that's it. So ywr.world.
It's fantastic. I've really enjoyed it. And before I leave you, so everyone should go check it out again, ywr.world. Go have a look at it. I think you'll be really happy with it. It definitely is, as you say, contrarian, and lots of charts, lots of different things to think about in there, and it really gets your mind thinking. Before we leave, I kind of chatted with you briefly on the Bloomberg, and you said that we were going to talk a little skiing.
Oh, wow. Fantastic. I'd forgotten about that.
Yes, that's right. So you grew up in Calgary, and then you went to Montana. And I also see that like your picture on this, on your letter is
avatar
is you skiing. So I take it you're quite a skier. Why don't you tell us a little bit about your favorite places, what you do? Are you still skiing? Tough in London, I guess, but.
Yeah. No, I have a strong view on this.
Okay.
So skied Montana, skied Calgary, Banff, Lake Louise.
Lake Lousy is what we call it.
Oh, do I like Lake
Louise? Oh, no,
it
is good. It's a good hill. It's just cold.
Okay. Yeah, it is cold, right? And I've done all the Sierra Nevada, Lake Tahoe, Heavenly, that whole scene. Skied Utah. Haven't skied Colorado much. Done Whistler. Okay, so I've done Vail, Aspen. I've done almost everything.
Okay.
And also skied on the East Coast. Europe is the real deal. I am so in love with the skiing in Europe. I don't think I have a hard time coming back to the US.
Yeah, because it's all about the tree line in Europe, right?
It's the tree line, and it also feels like I'm on a hamster wheel. The runs are so short. I'm like, oh, let's go on the chairlift again. Let's go on the chairlift. We're going on the chairlift 20 times. Where I'm like going on these zooming gondolas in the Alps that are going up like 3,000 feet or whatever. They're like, you're having runs that are 30 minutes long. Now, and I want to say that's fine in Europe, but I also want to say it is so much cheaper than the US ski.
Vail has ruined it. Like Vail came and bought IntraWest, and they've just made a mockery out of it. It's insane. Yes. It's twice as much per day to ski in North America versus Europe.
Now the pushback will be the whole like those passes, right? And
Yeah, but you got to kind of, so yeah, great. So you live in Whistler, you get a pass and it's great. But for the, like, if you go show up, like my son and I went to Whistler he was looking at universities.
No, yes, if you pay
it was,
what is
I
it?
thought it was like $300 or something. It was some obscene.
A person.
Yeah. I thought he had bought a week. I was like, what, you screwed up, dude. Like you got the wrong one. And then he's like, no. And I'm like, holy shit. It cost me $1,200 for us to go skiing for 2 days.
Okay, and where do you live, Kevin? In Toronto?
So I live in Toronto, but listen, I used to go cat skiing every year. So I actually gave up on actual resorts. And once I got a taste of cat skiing, which is kind of like the poor man's heli skiing, I was like,
Yes.
it was like tasting meat for the first time. I couldn't go back.
Okay, so you've kind of moved off the resort.
Yeah, so I actually very rarely would I go skiing in the resorts. We would go do like a day at like Lake Louise or, Golden or something to warm up. On our way, we would do interior BC usually and go to one of the cat skiing operations there. But once you kind of get it, have you done that? Have you gone cat skiing yet?
I haven't, but what's the place in BC that you go? It's very
so there's a couple. The one that all the guys, a lot of Bay Street owns is this place called Chatter Creek, but there's another one called Mustang Powder. It's near Revelstoke.
Yeah.
And so Revelstoke, actually, funny enough, we used to go to Revelstoke before it was an actual mountain, like a resort. And we used to go ski this place. And we used to go cat skiing there. And then the last year, on the way down, they had cut out the gondola run. So the guide says to us, you guys want to ski down to usually we would just take the cat down the last bit. But he says, you want to ski down the thing, and they've cut this gondola run out.
They've cut this line.
Yeah. So we say, sure, what the hell? Why don't we do it? And it was just brutal. It was like we were already like our 4th day. We got chopped up. And it was just like it was, and it's, like when you cut a run, it's not as nice as like the natural terrain. So it's just cut through this terrible part where like there's cliffs we have to go off of. Yeah, exactly. It was just disaster. So halfway down, we're just like, there's like bodies everywhere. It just looks like a gong show. And my buddy, who's like this investment banker, says, what are you going to call this? Kill the Banker. Because it was like we were all getting crushed. And sure enough, they named it Kill the Banker. And that was my buddy. That was my buddy's run name. I always still laugh about it. Like it makes me laugh. But yeah, once you got to go try cat skiing. And I do agree with you about Europe. The money and also the above the tree line is just awesome. When you get it right, it's great.
Yeah, my message is like, look, if you're on the East Coast and you're going to fly 3-4 hours anyways to somewhere in Colorado or Alberta, wherever, for 5-6 hours, I think you will save. The ski resort I go to, it's 60 euros a day.
So where do you go?
Lift ticket. I like to go to Teen Val d'Isère.
Oh, okay.
But like if you're a family of 4, you're probably going to save $200 a day on lift tickets. Like it pretty quickly pays for everything.
Yeah, and it's also a great experience.
And it's awesome. Yeah. It's fun. The food, the meals are cheaper. The whole thing is great.
So have you ever heard of St. Anton?
Oh, God.
Because I saw some videos, like YouTube serves me up some stuff, and it served me up some guys that were taking the gondola up, and then they were hiking. And I was like, oh, geez, this is great. And I couldn't believe this was like inbound and they were allowed to do this.
Yes. This is the other ridiculous thing about Europe. I don't know. I don't understand culturally, whatever. There is, when it snows, almost 99% of the people stay on these very narrow runs. You can ski untracked. The negative is they don't avalanche control it.
Yeah,
right?
You need to.
The basic, your basic view is get your pack, your peeps, your shovel, and you are free to ski whatever you want, and it will be available. There will be thousands of acres of it untouched for days, and you can have at it in a way, like, and you know how it is in the US or in Canada. If there's a powder day, it is done by 11 o'clock.
Yeah, Whistler gets tracked up like by lunch. You like 100%.
Yes, and I'm like, I don't know what the deal is, but in Europe, it's untouched.
Yeah,
they're like afraid. Like, I mean, well, that partly is they're like it's risky, right? They're like, oh, you could get an avalanche, and it really does slide because there is, there aren't the trees helping it,
right?
And also the only negative also is if you go to Europe and you do get a lot of storms, the lack of tree line makes it really hard to ski. So,
Oh yeah, no, I've been in situations like that. People do, until you experience it, you don't understand how tough it can be. Like I remember we would go, and that's when you have to go into the trees and get out of the,
yeah. And there isn't much,
Right.
right? They're just,
because we had times that we were literally be standing and the fog, like the thing with the visibility go down to zero, and people would just fall down standing, like literally
Yes.
waiting. You just fall down because you lose track of where the.
totally lack of contrast of anything. Yeah.
All right.
But
so
that's our message for our other, like we try to add value
That's
in
right.
the markets, but I think this other thing is also, we've added incredible value, that there is a world of amazing skiing at 1/4 of the price if you would just think east instead of west.
That's right. So I hope Europe sends me the check for the advertisement we just gave, and we'll split it. All right.
Yes,
Listen,
exactly.
we'll get you back and we'll talk about mountain biking because I think you're a mountain biker as well. But in the meantime, everyone go check out Erik's blog/letter. And Erik, thank you very much for your time.
Kevin, thanks so much. It's lots of fun.
Take care. All right, Patrick, it's time for Talking Charts. What do you got for us?
All right, well, let's talk about the top 3 things we were watching 2 weeks ago. We were watching the OPEX, which ended up actually not, the quad witching didn't end up being anything spectacular. I mean, there was a little bit of gamma pinning. It was a bit of a quiet week going into the final day, but nothing big happened. Did you?
Yeah, there's no fireworks on that.
But the interesting thing was number 2, which was the FOMC. And, I really thought Powell was going to at least try to cool everyone off a little bit with these kind of inflation numbers coming in, but everyone interpreted him.
So everyone thought that, Patrick. Everyone was looking for Powell to come in, push a little back against the inflation and push a little back against the loosening of financial credit conditions, and there was nothing from him.
Nothing.
He was about as dovish as you could be.
Yikes.
And by the way, I blame this on me because I think the previous time you had put FOMC as number 1, and I said, no, flip them. Inflation's more important than FOMC. And I was wrong.
And you were wrong. Yeah, you know what? All of these things we put as top 3, I mean, in years past, these kind of things mattered, but the first 2-3 months of this year, it's been just the same thing. The market goes up, pauses. Market goes up, it pauses. It's been an upwards channel, relentless, and nothing's been able to shake it. Nothing. And
right, but the FOMC was a big day. There was a lot of excitement. That was outside the realm of that was where the surprise came over this past 2 weeks.
Yeah, for sure. So let's talk about the top 3 things to watch in the coming 2 weeks. Kev, you're gonna love this one.
Well, you didn't ask me, so you have a better chance of being right this time. Oh, God, U.S. dollar.
Yes.
That's why you didn't ask me, because you snuck it in there.
I snuck it in
Surprised
there.
you don't have it as number 1.
Okay, well, I want to talk about the dollar, okay? Now,
Really?
all right, so listen, the dollar has been dead in a sense that it's been in the dead center of its trade range. So if you define the entire trade range for the last year, right? It's been trading more or less in the dead center of its trade range. Like it could not be more neutral, and there was zero trend in the currency, and yet there right now. The pattern typically was that these kind of rallies would stop at fib zones, and yet today. And it happened really well. First, it started with the Bank of Japan and the move in the U.S. dollar yen. Great call on that, Kev. And then came the pound sterling, which also broke.
The fact that you're giving me a hard time about that is great. I love it. Bring it on.
Oh my God, yeah, because burning the red on your screen is just bring it on. I like to burn. All right. So the point, though, is this U.S. dollar move, particularly yesterday and today, I think really does put some big, upside dollar moves in play, particularly since it's happening against many cross currencies. The euro had a breakdown. This 108 is a line in the sand for me. But that pound sterling took it pretty heavy after the Bank of England came out. It's coming down to like a 4-month range at the bottom end of its range, also on a line in the sand. And the US dollar yen continues to consolidate right along the level where it's about to break out to a fresh high. And so we have a scenario where it's the thing to watch. Did the US dollar officially break out? No. But this is all of these things are on tilt at very key technical levels. And either this thing is going to reject and push this right back into the trade range, or we got a dollar move. So it is the thing to watch. I'm sorry. I win.
No, listen,
I win.
That's good.
So
you're in charge of those anyway. So of course you're going to win.
So the point though, this is a very important moment, that US dollar yen, because I mean we could see 155 on a push, and I think that could disturb the intermarkets a little bit if that kind of weakness starts to emerge in the yen. Obviously, you are leaning into the fact that this previous high is going to reject it, aren't you? No comment.
I don't want to say anything in fear of gootring.
Okay. All right. Good luck. All right. So number 2. A thing to watch is the jobs numbers. Actually, shockingly, very quiet next 2 weeks. Very few major headlines. I mean, obviously, we have Fed speak here and there, but nothing like this. FOMC was that kind of big economic news release. All the central banks have talked. At this point, we're waiting until April for jobs numbers and earnings. It's no big economic news releases at this point. So the next big one is the jobs numbers. Whether the jobs numbers moves the market is a whole secondary question, but there really isn't that much to choose from in the next 2 weeks. Any comment?
Okay. I have no comment. What's our number 1?
Do the Mag 7, does the advance continue on them? And particularly, I said Mag 7, but it really is, does NVIDIA keep breaking out?
Yeah.
Well, I have, it's Mag 1. Well, actually, no, there's a bunch of Mag 7s that have started to participate. Let's get to the charts and let's just talk about this. So NVIDIA, I made a call to my members and I basically said, when NVIDIA tops, the S&P tops. And so the biggest puzzle piece is, did NVIDIA's bearish engulfing candle end its advance, or was there one more advance? And clearly, after a 5-day consolidation that didn't even Fibonacci retrace, it was just like a little consolidation flag. It's ready to go. Like if this breakout happens, we could see 1100. On the upside. Like it's not going to stop at 1,000 if this breaks to a new high. And so this thing could go. If NVIDIA goes, then S&P could be 5,400. Like as much as I am skeptical about the stock market, I think NVIDIA is such an important sentiment thing that if it keeps going, the market will stay stable. Do you disagree with that?
Well, I'm actually bullish the rest of the market.
Okay.
And maybe NVIDIA goes up. You seem more willing to entertain that it's going to continue than I am.
It's the bubble. It's where the money's going. That's the poster child.
I can't bring myself to even be hinting this thing's going to keep going. I'm not going to call for the decline, but like it's insane. Like it's nuts.
Yeah,
I have a good friend, and he said something to me. He says, you got to stop writing about Mag 7. You can't buy it. You can't short it. Just forget about it. That's how I feel. Like, there's so many other good looking. Well,
stocks. You could buy it with, you could. An interesting strategy that I was just talking with on another show was this one guy.
Wait, you go on other shows?
Yeah, it's weird. But the thing is that the guy was putting on the trades by doing bull call spreads, but by going in the money to the point that it's this price is at the midpoint of the bull call spread, you're basically just buying intrinsic value. It allows you to be participating on the upside of the trade and have upside, but yet a very limited risk. And that's really the strategy here, is because ultimately momentum's on your side, but you don't want to be the bag holder on Delta One equity when this thing turns. And so it's like, how do you participate on the upside and take advantage of this momentum without taking the downside risk of getting caught in a bad reversal?
Well, it could be. Hey, you want to name where your show you went on?
No. So let's go to Microsoft.
It's all right.
So Microsoft, look at this, fresh highs, plugging away. You have Meta, breaking out toward its highs. Amazon trying to break out 52-week highs. They're all going. Only Apple is the dog, right? Obviously Tesla's been the only one that's outright bearish. This is not even a distribution cycle. This is a bear cycle. I
don't want you talking about this anymore.
Okay. Point is, it's an ugly chart.
Petrified you are going to Gucci this. So
I'm just saying it's a downtrend. Okay, listen.
That's
it would only be a Gucci if I told you I was loaded on the short side.
Maybe,
then
but
that would be
making me
Gucci.
nervous talking about it.
All right. But the other one that is still incredibly weak is Apple, and so you've got a scenario where Mag 4s are running, right? You've got some of the other ones participating on the upside, but it's really, in my opinion, about whether NVIDIA goes. So let's watch and see what happens there. So let's talk about the rest of the market. So the S&P 500 at 5,300, and this rally's been relentless. It's been in this upwards channel, thick crayons here for this little channel, and all year it's done the same thing. It's rallied, paused, 2 steps forward, 1 step back in an upwards channel, and nothing has shaken it. It's just been a pure systematic rise on this. And I wouldn't be shocked if the little continues a little bit longer, because ultimately it needs some sort of a catalyst at this point. Something has got to spook investors. Everyone has become so complacent, but the thing is that the short sellers are broken, and so at this moment it's a matter of just seeing what will ultimately trigger some mean reverting correction. At this moment, it's a very clean bull trend. But what was interesting, because you were highlighting you're bullish the rest of the market beyond Mag 7. The interesting thing is you can see a little bit of acceleration in the equal weight, which is supporting your idea, which is that before, when we were there in January, the equal weight index was stuck in the mud and doing absolutely nothing. But really, since it broke out after the earnings season at the end of January, it has been slowly accelerating to the upside. And it's interesting to see that, because the breadth of the market is still not that great, but yet the equal weight is doing just fine.
I'm going to push back a little bit on your idea that there's nothing to stop the market from rolling over. And I might say that this Powell move was one of the last things that the bears were clinging to, meaning that they expected him. Oh no, just wait till the Fed comes. They're going to show you. And I think you even expressed surprise that he didn't push back against it.
Yep.
And I might contend that markets top on the absolute best news. And that the fact that we don't have anything to worry about anymore is not good news for bulls.
You know what? At some point, markets fall under their own weight. It's like gravity, right? Like at some point when the rocket fuel that's been fueling the upwards move, once you've exhausted the fuel, then gravity ultimately grabs it by the ankles and drags it right down. And maybe that is a good way of kind of explaining your scenario, which is that ultimately you're saying is that all the money's on the sidelines, cautious, and then when everything seems all green like all go ahead is actually when all the money finally exhausts itself and then puts in the top.
You think about it right now, it's tough to find a reason to be bearish. I would argue that the scariest thing about this market is that there's no reason to be bearish. There's no wall of worry to climb. The only wall of worry is that we've actually are up so much.
I'm bearish, but I'm always bearish. So
you're always bearish, and in fact, you sound like you're at the margin shifting. At least you're extending when you think the bearishness is going to come.
Well, you know what? The thing is that the option strategies that we're implementing, we've been adjusting on a rolling basis. So, like on the SPYs, we're already at the 525 with our puts. We've been doing like calendared straddles and other things that have been absolutely fantastic. And so, if it starts sooner, I won't complain. All I'm just I just don't have there's nothing technically bearish on any of the charts. There's no indication.
I'm not going to disagree. I'm just saying that the fact that there's nothing to worry about is worrisome.
I like that. I like that. I'm not going to gooch her for you. So you heard it from Kevin. Okay. So let's talk about let's not talk about Bitcoin. Let's talk about gold. The interesting thing about this gold move is that generally I would think that gold would have its strongest move once the easing cycle is underway, but clearly it's been very well bulled. But the price action or this pop and drop that just happened here is the first kind of puts it to my attention as to what just happened here. I mean, ultimately, there should have been no reason why gold was not following through to 2,300 when it's broken out this way and a flagging formation breaks on the upside. But the sellers hammered it right away. And they gave back the entire gain. How do you size up the move?
So first of all, gold has rallied as the U.S. dollar has rallied, as rates have risen, much to everyone that focuses on those two things. I keep saying, stop looking at those two. This is something different, and it's moving because of central banks, and I think they trade differently. So it doesn't surprise me that it does weird things. And I'm not saying that technicals can't work, but I'm saying that the action where it seems like all of a sudden there's sellers and then there's no buyers.
The technicals have worked fantastic on gold. I mean, it's been incredibly
not really
clear.
Like, what was the thing that there was very few people, even the technicians, that were bullish. Well, maybe I'm wrong. But there's very few people.
Okay, bullish in advance. But when this trend line was broken out, when that move happened back at the 1st of March, that was a technical buy signal, and it did follow through to a measured move. So there, in my mind,
okay, maybe I'm wrong about that.
Technically,
but
it was a breakout.
I didn't find a lot of people going, "I'm going to."
There wasn't a narrative. There was
100%. In fact, it was the opposite. Everyone's like, "It's going to fall back down." Blah blah blah.
Yeah,
and people are just quick to be bearish gold because they're focusing on rates in the U.S. dollar.
Right.
And I think what's happening is that the central banks are moving it. At times they're gone. And then at those points, the more financial buyers and sellers emerge and they do some funky things with it. And then all of a sudden next week, the central bank buyers will be back and it'll look great again. So that's my only point, is that the nature of the
I will tell you this. The chart, the breakout was so bullish that in order for there to be any genuine technical damage, you'd have to be south of 2100. And so, any pullback here that even, let's say, drops temporarily to 21 and a quarter is a buy on dip, because it's such a clean bull trend that dips need to be bought now. It's working. So let's watch and see. Let's move on to crude oil. Still very well accumulated, and old dips are defended, and it'll be very interesting to see whether this little few days of pulling back stay above 80, because the pattern of higher highs and higher lows should keep this going. And if this was a legit breakout in oil, that should be bought on dip, and we should see an advance to 85. I think, a lot of people use the excess capacity and surplus and all this other stuff as reasons why oil won't go to 90. But I actually think that there is plenty of dry powder for this to burst toward 90 plus just on short covering. There are so many people out there convinced that oil can't go that you have to believe that I don't know what the exact positioning is, but there's got to be some big hedgies that are betting that this thing is going to stay stuck in the mud. If they're forced to cover, we could still have a burst right to the highs. But even then, I don't think that has to be a bull case. If you go like on a much bigger picture chart, oil could stay range bound in this kind of $70 to $90 range for the whole year. But we might just go to the top end of the range and then head right back to the bottom end of the range. And so right now, I'm giving the bulls the benefit of the doubt that they're going to make another punch on the upside.
I think that's one of your better analysis, like technical analysis.
Yeah,
I like it.
All right.
I like it.
That means it's not going to work.
Yeah, probably gonna punch right through that.
I was just hoping you didn't like it so that I had a shot. All right, so nat gas has been dead, and one of the things that I was highlighting, this is I'm going to focus here just specifically on the April contract, and it's trading right along its lows. What I'm curious about is whether we finally see this stop its distribution, even if it doesn't mean it gets bullish. But there's like, if you go back to the prolonged consolidation of 2023, after it hit the double bottom, it stayed flat down there for the entire summer, but it stopped going down. And this is what I'm curious about, is that have we discovered the lower boundary of nat gas? And that in itself wouldn't necessarily mean that there's a buying opportunity, especially with that contango curve. But
maybe you should sell puts. Nakedputsellers.com.
Yeah, because the Widowmaker, and maybe I should do 3x leverage on the entire portfolio size at the same time.
That's right. When it moves against you, more. That's a key part. You gotta remember that part.
Oh boy. Anyway, if you're going to sell puts on the nat gas commodity, do it in small, reasonable size, manageable size. And to be honest, the out of the money strikes are not expensive, so you can really construct it as credit spreads. There's no point in taking naked risk on income writing on it if you're going to be a rock star on this. The silver, a little bit of a bearish engulfing candle. If it pulls back to 24, it's the buy on dip. On that. Copper, a similar situation. I'm actually a little surprised that it beat $4 with the momentum it did. But the interesting thing here is that will it, like all these other charts, be bought on dip? Everything had this burst higher. Everything is now mean reverting. That's typical. For every advance, the market typically gives back half of its gain in that natural ebb and flow of waves. The question is do the buy on dip traders come in and support this along the way? Do you have any, are you still bullishly leaning towards copper?
Yeah, I think in the long term, it's headed higher.
Well, long term.
I like the fact that nobody knew why it was going up.
Yeah.
To me, that's the kind of bull market I like. I know other people are like, oh no, I want to know why. I don't want to. I'd love markets to go up when no one's expecting it.
Yeah.
To me, that means a lot more.
Well, that's something to that. Yeah, that's why it's interesting that the gold made that move, because it's one of those scenarios. So it's not when it wasn't from a narrative perspective the right timing. It just started to go,
right,
and that supports that. Nonetheless, uranium, the U.UN, the Sprott Physical, had some nice days back to back, kind of bouncing off its very oversold conditions, but there's an important line in the sand just above $30. And one of the things that I'm watching here is this already a short-term low? or is there one more zag in the zigzag, right? Where a lot of times these corrections have more than one decline leg. And so one of the interesting things is that if it can't beat 30 with any momentum, you have to still be suspect for at least another trip that might even temporarily break to a lower low. Overall, I was making...
Oh, go ahead. Finish
I was just saying, I was making the call that the $25 to $27 area was a very attractive buy zone, and if it trips down there again, even if it temporarily drops below 25, I still think that 25 to 27 is a very nice buy zone, and if it has one more trip down there, I'll just be buying more.
I like the fact that you're saying that at 30 here, that might be time for it to pause, because I was just pulling up the NAV and looking at the kind of price or premium or discount to NAV. And we were down to minus 16 at one point.
Yeah.
And I see we're now at minus 1.5. So to me, you could get a move back down to your level just by the 10%. Discount to NAV going back to where we've been.
Yeah. Yeah.
So I'm going to look at that. I appreciate that heads up.
Yeah, it's interesting.
I'm not going to look at it the way you're looking at it, though.
I know you won't, but that's okay.
I'm going to look at it on the dark side. The dark side. For trade only, though.
Oh, all right. So treasury bonds. Oh, I love these things.
Oh, no, so good. You lock in forever and ever and ever, and you just get a fixed coupon no matter what, even if inflation is 10%.
Anyway, the 10-year bond is since Powell and FOMC is actually off its worst levels. Now, it's still nothing impressive of a bounce. I don't want to go and write home about it. But overall, this entire pullback on treasury bonds for the last 3 months has been just a 50% retracement of its rise. And you know what? The fact that nobody loves it, I don't know.
What do you mean nobody loves it? Everyone loves it.
Oh, no.
That's why the curve's inverted.
Well, I think okay. I don't think because it didn't sell off the same way. Okay, whatever. I don't want to get into a huge debate. Bottom line, I actually am cautiously watching whether we can beat the 112 level on the 10-year Tino futures. If it gets above there, it might open up the window for a run, but I think there's still a little bit more work to be done here. But watching. By the way, Kev, did you notice how junk bonds are just relentlessly rising? The rest of even investment grade, everything's been pulling back, and junk bonds correlate much stronger to equities, but they haven't even reacted. The credit spreads have narrowed to like 3%.
You're absolutely correct. The credit spreads just keep getting tighter and tighter and tighter. The economy is better than everyone thinks. The bond market. Remember what the people used to say? Bond market's the smartest market out there. I'm not sure that's correct.
I just puked in my mouth.
By the way, I was chatting with our buddy Chase Taylor.
Okay.
And he was talking about how he went back and read this book, Is Inflation Ending? Are you ready? By the way, Chase has got a new podcast. And Brent Johnson's his first one. Go listen to it. Chase is a good guy, friend of the show. Is Inflation Ending? And this book was written by Gary Schilling and Carol Sokoloff, 1983. I think you should read it.
I think I will.
It sounds like your kind of book.
Do they have an audio book? I don't read well.
Is there lots of pictures?
That's perfect.
I thought this
Can I
was
use
really
my
interesting
crayon?
because I feel like someone should write is inflation starting. Are you ready? Maybe Chase and I could write that.
Yeah. I think that would be great.
Yeah. 2020, how many years is that? 23.
Like 40 years, whatever.
Yeah.
All right, Kev.
That's it?
That's all. Did you want me to? Is there another chart you wanted me to mention, or is that all right?
No.
You know what? Actually, one quick one. I just wanted to touch on. Ever since the yen weakness, the Nikkei just took off again, It paused for 5 days, blast off to fresh new highs, decisively above 40,000 now. I mean, this measures out to 42, 43,000. Nothing seems to be able to stop this. It's running. Congrats on that call, by the way.
Stop thinking about it. Just own it.
Oh, okay. Crayons with Kev, buddy. What chart do you have for me?
This is a funny chart because everyone was losing their shit about the CNY move today because it broke through 720 or whatever. What is the real CNY? And so I was like, oh, everyone's losing their shit. Yeah, because we moved from 720. We rallied up, and that had been overhead resistance. Can you pull up CNY? Are you able to show that chart in the meantime?
Yeah. 1 second here. You want?
So just pull up a chart of CNY. Let's just look at that. Or CNH. It'll be good enough.
No, CNY.
Okay, so here's the chart of this thing. You could see that there was overhead resistance at 720, and then it, exploded higher today. Exploded, quote unquote. It really didn't move that much, but people were losing their shit. So one of the things I was like, oh, why is this? What's going on here? And I went and found the CNY versus the basket of currencies that they, peg this against. And that's this CFETS baskets. And I've just, showed this chart. And I'm going to go out on a limb, Crayons with Kev, and say 710, it's going to stay.
You know what? I mean, it's funny because if you're looking at it against the basket, there was some pretty big currency moves today, and so
no, but it's just funny because it's really the other stuff moving, not the yen, or sorry, not the renminbi.
Great observation, Kev. It's I didn't pick up on that.
I figured that's a really good value added on like taking a peg currency and applying technical analysis to it.
Genius.
Yeah. So for those who don't know, it basically the chart for the past 4 or 5 months has been 710, just in a straight line almost. And
shockingly, it's still at 710.
And so my prediction is that the Chinese yuan or renminbi, I'm not sure why you call it a yuan or renminbi, but that will stay against the basket at 710.
All right, great call. You know what?
Thanks, man.
Let me analyze your crayons with Kev.
Okay.
Very good line drawing. The trade range prevails. All right, let's end this show.
That's what happens when I forget to do crayons and Kev ahead of time. All right, thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow on Twitter. Daniel gets bored there, and so you got to go check us out at the Market Huddle. It's actually maybe not Twitter, it's X now. Patrick, where can they find you?
You can find me on X at Patrick Sresna and follow me at bigpicturetrading.com. Kev, where can they find you, buddy?
You can go check me out at themacrotourist.com, and you can come to our chat there, /chat, and you can welcome to join us. And listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. Now stick around for the after show. All right, Daniel.
All right, pull
out your tasting notes, buddy. And when he told us, I was just saying, this is like so perfect. Daniel is just like, he's like,
I was so tired of drinking alone. I just said, I just want a drinking friend. I just want one.
And you're
like, I'm gonna go out of my way and get Daniel a beer. So
the problem is when you have drinking friends, you have to understand that they also like to drink. So if you get desperate, you got to reach in and grab something, right?
Did you do it by accident, or you were like, "Oh no, I just need a beer"? And you're like,
I need, yeah. And I was completely out, and I needed something. And where I live, there's no shops.
So you know what? I next time I'm gonna give him a 6-pack and the beer that he's featuring. So that's that way. Winning.
Okay, so let's get out the tasting notes. Start with Daniel, since he's written his down.
Oh yeah, sorry, I didn't actually read out the tasting notes of the beer. For me, I actually thought it was really good. It was quite smooth, a little bit hoppy, nice and citrusy. It was an easy drinker, to be honest.
Marks and Spencer is like that shop where you buy like clothes and stuff, isn't it?
Yeah, I feel like I didn't describe it very well. So it's
a department store, is it not?
Yeah, for posh people. Yeah.
Okay. For posh people.
It's
posh people and old people, yeah, pretty much.
that citrusy taste pops out. I'll agree. But first of all, give it a rating. 1 out of 10.
I think it's a solid 6.
Oh, see, that's an amateur move. You're already starting off with the even numbers.
Even numbers. You always have to give it a decimal. And the second thing,
6. I like the style,
so
I was
by-
always low.
but he hasn't got onto the pattern that we only rate something under 5 if it's complete dog
No,
shit.
listen, he can choose his own pattern.
Yes,
if
he
he's going to
can.
be bold and wants to call for 2s and 1s.
That's
let him.
true. Who am I?
Yeah.
Who am I to give
Exactly.
him the
Don't put our morality in terms of our doing it. I will say the even number is a little bit of amateur, but otherwise, if he wants to do even numbers, let him do even numbers.
All right.
So a solid 6.
I didn't realize it was going to get so judged.
Yeah, and so we're going to find out in the future where 6 stands on your scale. So it's a little bit
Yeah.
of a journey. We're all going to learn. All right,
Exactly,
Patrick, where's yours?
Now, so IPAs, the hoppy and citrusy taste, it usually comes with a very heavy like alcohol taste. That like this is an incredibly smooth IPA. Like it obviously it's probably because it's a lower alcohol, 5.5%. But this is, Kev, I'm going to say the word. What word am I about to say?
Oh God, no! I'm not going to say it. You
Say it. You say it. It's sessionable. It's sessionable. It's a sessionable beer, Kev.
I was thinking the exact same thing.
Thank you, Daniel.
Yeah.
See, I like him. Yeah.
Yeah, well,
See-
he just like because he drinks with. He doesn't even drink with you. You shouldn't like him.
I do drink with Pat, though. That's the problem.
That's true. Yeah, I can just see you two degenerates in Portugal.
pretty much.
Oh my God.
Okay, Patrick's got
All
things to do,
Yeah.
and it's getting late for both of you. So we're going to let you go. Everyone have a great week. A couple of weeks. We'll see you on the other side.
In April. Cheers.
Take care.